Momentum fizzles out on the street with the Nifty falling below the 24K mark as banks underperform even as broader indices see some traction. It's a mixed show across indices with buying in metals and oil and gas. PSU banks sulk. Ultratech Cement remains constructive on demand driven by infra, housing and urbanization with the management guiding for 7 to 8% sustainable volume growth. Brokerages remain bullish. Meanwhile, Coal India delivered a steady Q4 with profit growth supported by higher production. Adani total gas gains after a steady quarter with double-digit revenue growth in both revenue as well as EBITDA supporting earnings momentum. Meanwhile, Jindal saw decline sharply as margins compress and profits fall on weaker realizations and higher costs. Maruti is expected to deliver a strong Q4 with double-digit revenue and earnings growth driven by volume recovery, better pricing and improved export mix, while margins may see slight expansion supported by lower discounts. Eternal is expected to post a steady growth driven by Blinkit's strong expansion while core food delivery remains under pressure. Margins may improve gradually aided by platform fee hikes and operating leverage. The RBI finalizes its ECL norms, keeping provisioning requirements tight and offering no major relief to banks. PSU banks are likely to see a sharper hit due to lower buffers, with higher credit costs expected to weigh on profitability and return ratios starting FY28. Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita. Very quickly on to what's playing out on the Nifty. A third of a percent lower on the Nifty 50 index, where though holding very well on that 24K mark, just about holding the 24K. We've slipped briefly to 23,963. That was the low for the day, but we've bounced back basically in around the 24K number. Now, that becomes an important level to look out for. In terms of just the overall index itself, the breadth, which was positive at one point of time, has turned sharply negative. We've got 17 advances to 33 declines on the Nifty 50 index, so 1:2 on the advance decline. Some of those which are under pressure is an Eternal, an HCL Tech, an Axis Bank, a Shriram Finance, an Ultratech Cement. So, and within that pack, you'll see a couple of those with an earnings tilt. There's also an Interglobe Aviation, which is down nearly 3% in trade today. So that's the broad brush tilt. ONGC is the one which is seeing a bit of a spike, 4.5% higher. Coal India on the back of those numbers, 3% higher. Adani Enterprises, Nestle are just some of the other big movers in trade, with Adani Enterprises up 2.5% in trade today. When you're looking at the Nifty Bank, 1.3% lower on the Nifty Bank, and it's the PSU banking index which is actually causing the largest drag on the Nifty banking index. Let me first pull out what the PSU banking index is doing. 2% lower on the Nifty PSU banking index. The Nifty Bank currently 1.3% lower. And the tilt, let's pull up the constituents on the Nifty Bank as well, because that'll give us the tilt. In terms of Union Bank, Axis Bank, Can Bank, IDFC First Bank are some of the bigger losers in trade today. That those norms getting finalized by the RBI not helping any of those PSU banks. In fact, HDFC, ICICI, Federal Bank, even a Kotak Mahindra Bank just seeing mild gains. But outside of that, all of the other constituents outside of Kotak and Yes are trading in the red. So you're seeing pressure within that banking pack. IT, though, curiously, also trades in the red, 0.7% lower. And what we're seeing in terms of the gainers is energy, oil and gas and metals. Really, that basket of stocks continue to outperform. So you're seeing that continued resilience seen there. Defense has given up the gains of the morning. FMCG also is trading in the red. Realty is trading in the red. Auto is also trading in the red. So there's pressure across sectors, no matter what you seem to be playing outside of energy, oil and gas and metals. Within the Nifty 500 basket as well, the breadth is weak. 200 advances to 300 declines is what we're seeing broadly. Leela Palaces is the top loser, 5% lower on the back of numbers where margins seem to have compressed. Union Bank is down 3.5%, I beg your pardon. Within that PSU banking pack as well. Eternal is also down. So those are some of the bigger names within that Nifty 500 basket, which seem to be seeing pressure. India Cements is down 4%. SBI Cards is down another 3% from yesterday's close. You're also seeing OneSource down 3%, Thermax down 3%. So you're seeing pressure on all of those names. Cohance Life, though, doing very well for itself. Second straight day, the stock has now gained nearly 35% this week. So you've seen a fabulous move. Tata Chemicals is up 11% on the back of Rallis's numbers. We're seeing a decent move with regard to Piramal Finance and Intellect Design. And some of those names seem to be coming back into favor. Again, Piramal Finance, in terms of the numbers, were very, very strong. And we'll try and get you that management commentary from Piramal Finance at some point of time in the show. Let me bring on board Karan, though. He's got that entire list of buzzers, or rather, a small list of buzzers on his list. Karan, what's on your list today?
Let's start off with Unimec Aerospace. The stock is buzzing on the back of the volumes being 3 times the 20-day average. The company has recently forayed into the renewable energy segment by forming a new subsidiary in the name of Uniflux Renewable Energy Private Limited. So do watch out for Unimec Aerospace. Followed by Paris Defense, the company has signed an MOU with Complex Systems and JV Micronics. On that note, these 3 entities will integrate their respective expertise to collaborate and pursue opportunities both in India and international markets. And this is for the design and development of anechoic chambers. Ramkrishna Forgings is also in focus on the back of the volumes being 4 times the 20-day average. And recently, remember that the company had announced a significant capacity addition of 40,000 tons per annum. MobiKwik, a block deal has happened which involves 7.6% equity stake in the company. And yesterday, the company had announced that the company had secured RBI approval for its NBFC application. Piramal Finance is also buzzing in trades today on the back of its strong Q4 numbers, wherein the consolidated AUM grew by 25% year-on-year to cross the 1 lakh crore mark. The growth visibility is supported by branch expansion and focused scaling up of new segments such as gold loans and microfinance. And finally, we have Canara Robeco. The company has reported a mixed set of numbers. While EBITDA is up 16%, the EBITDA margins have improved substantially at 62%. However, on the flip side, the profit is down 21% at 41 crores.
Yep, so those are just some of the names which are in focus today. Let me bring on board Kunal Bothra as well. Kunal, some weakness in markets. Would you be disappointed with the move or along expected lines?
Yeah, along expected lines. It's the expiry day today, so I think it's bound to be that the positions have to be rolled over. There are a lot of adjustments which have to happen for the index. And after I think a phenomenal expiry at large, start from where we know the markets took off from the end of March and start of April towards where we're closing. I think 100 point plus minus for the Nifty would be taken with a degree of maturity by the markets. So not too much faced by the happenings on the equity front. But then I think what's happening across the commodity front, I think should keep the markets on the edge. And I think that's one of the reasons why I would believe that we are seeing such kind of a reaction on the indices, because Brent crude has climbed back above $110, $111. So that I believe could probably keep the markets under edge, because any further rise in the Brent crude prices, I think would put a direct pressure on the indices going forward. And as it is, I think you see over the last 1 or 2 days specifically, the stocks which have been directly impacted because of the rise in Brent crude prices, whether it's the OMCs, whether it's the paint companies, stocks like Interglobe Aviation, etc., these stocks have not participated in the last couple of days. So there's that slight bit of nervousness which the markets are showing today. Let's hope that it doesn't trickle into the next couple of trading sessions.
Okay, excuse me. And, Kunal, when I'm looking at the FNOQs, and unfortunately we don't have Sajid to give us that, but when I'm looking at the Qs, there's a huge build-up with regard to the 24-100, where there seems to be this huge resistance getting built up. There's also 24K, where there have been open interest positions which are getting added. Do you believe that 24K is crucial now and 24-100 is a big resistance, and therefore we are now exposed to more downsides than upsides, even though you seem positive?
See, what happens is on the expiry day, 24,000, 24,100 strikes or at the money strikes, they become very good hubs where option writers, they try and take advantage, because then you are playing with theta decay and all of the Greeks which play out at the time on the expiry day. So it becomes a little bit more convenient, I think, if I can probably use that word, to try and go for option selling on the day of expiry, because if your view stands out to be on the right side, then you stand to gain a lot more higher as compared to the view when you're buying a call option or maybe buying a put option, and if the view doesn't work out. So that's the only advantage which is happening in terms of the option writing, and that's why you're seeing a sudden swell up of positions or a built up of positions at the slightly out of the money strikes. By slightly, I mean if the spot is at 24,000, you're looking at 24,100 and 23,900 as the out of the money strikes for both call and put respectively. So I don't see that as a substantial change, but it's a natural kind of a reaction from traders on the expiry day.
Okay, so nothing to worry about, and the bias still seems positive from what I hear. And this is despite the Nifty bank showing weakness today, Kunal, because that doesn't look very pretty.
It doesn't look pretty because it's bound to be. You have names like Axis Bank, ICICI Bank,
yes,
which are bleeding quite viciously, I think, over the last couple of days, and no signs of respite over there. And to add to the misery, I think the PSU banking lot also today, I think, is start to show signs of some bit of weakness over there. Now, the only respite which I'm looking out for to hold this view that the markets would probably stabilize is we don't break below the previous 2-day, 3-day swing support for the index. So if we break, for example, on the Nifty at 23,750, 800 mark, then that calls in for a sharper reversal on the downside for the indices. For the bank Nifty, that level would be closer to 55,000 odd levels on the spot basis. So maybe another 1% down from the current juncture is where I would believe that the markets could probably go into a short-term correction. But till that time it doesn't happen, the view remains on the bullish side.
Okay, so view still remains bullish. What would your bias be there for Kunal?
So in terms
Stock
of
bias.
stock bias, I'll go with buy calls over here.
Okay.
Few formidable large cap names. Bharti Airtel is something which I'll pick at the current juncture. I think the stock has not done anything, I think, over the last few weeks. But apparently at this 1800, 1830 mark, it looks like that the volumes in the last couple of days, the change of price trend, the slight turn in the indicators indicate that maybe we could be looking at a respite or a recovery into the stock in the near term. 1885 is where I would place the targets for Bharti Airtel. Stop loss could be kept at 1800 mark. And one of the high beta spaces, which apparently has done very well for itself, is MCX. So that's a stock which I think is completing a bullish flag pattern on the daily charts. The breakout has already happened about 2,800 levels today. So keeping 2,800 as a stop loss, would recommend a buy with a target of 3,000.
Okay, MCX and Bharti Airtel is the stock bias that Kunal is giving us for this afternoon. In fact, Bharti Airtel has done nothing, Kunal. In the last 6 months, it's in fact down 6%. And even year to date, it's down nearly 13% odd and absolutely flat over the last 1 year. So, that's really the tilt in terms of the stock bias. But what we'll do, viewers, is step into a very short break, continue coverage on the other side. We'll try and get you perspective from the fundamental side, of course, but we'll continue to talk stocks as well. Stay with us. Welcome back. In fact, let me also bring on board Meryl. She's here with the stocks that you want to keep on your radar, some buzzers in trade. Meryl, what's on your list?
Yes, here's a few stocks we've seen buzzing in trade today. Starting first with IFCI. Revenue for the company has come in at 265 crores, which is up about 19% on a year-on-year basis. However, profit is the biggest highlighting factor for IFCI. Profit has sharply fallen to 21 crores compared to 272 crores last year. Yes, that's right. That's a 92% decline. And clearly the big negative takeaway. That's why the IFCI stock is under some pressure today. Next up, Leela Palaces is in focus. Reports suggesting that we're seeing some profit taking in this counter because they have performed quite well in the last quarter. They've posted a strong set of numbers with profit rising 47% up to 172 crores, while revenue was also up nearly 14%, standing at 484 crores. EBITDA and margins both have grown on a year-on-year basis for the company. But moving on, RailTel is also in focus. They have received a letter of acceptance from the Directorate of Higher Education of Himachal Pradesh. This is for an order worth 20 crores, further bolstering the company's order book as well as improving its revenue visibility. Finally, also in focus is Jindal Polyfilms. The company is under the scanner after SEBI has issued a show cause notice. This is to the company both and as well as key management entities. Now, SEBI has cited disclosure as well as governance issues, and the company says that it is in process of filing a response. So yes, here were a few stocks that we've seen buzzing in trade today.
Thank you so much for that, Meryl. Let me bring on board Amit Gupta, Motilal Oswal Private Wealth, joining us this afternoon. Amit, great having you. Let me first start off by asking you the golden question. What are you allocating, or how are you allocating fresh capital? What's your guidance right now for viewers?
Yeah, so I think that's very interesting because we were sitting in cash also in our portfolios to the tune of around 20-25%. And eventually we are also seeing that despite crude oil prices going to almost 100, 105, $110 per barrel in that range, the markets have become little more resilient. In fact, mid and small cap, stocks, if you see, they were resilient in the recent fall also. And they have been performing well in the recent up move also. So we feel there are few themes where we are allocating more, and the primary theme is power. Because somewhere we have a feeling that we are going to see very intense summer and El Nino impact may be there. AC sales can increase this particular year. And the electricity demand, which was hardly 1% last year, it can go to even 5-6%. You are already seeing the peak power demand. Last year was 242 gigawatt. This time it has already made a new high of 256 gigawatt, and it is likely to move to 271 gigawatt. So I think power as a theme is looking very good. And in that, if you bifurcate, then I think renewable as a theme, we are also looking at, because the recent Central Electricity Authority, they came out with a projection of overall energy capacity of India, which is 538 gigawatt. They said that in the coming decade, it can go to 1121 gigawatt. So it's a 108% increase. But when I look at solar, it is 143 gigawatt, and it is likely to be 509 gigawatt. That means 255% increase. So that means this will remain a high growth segment. And we just have to put money into those players who are looking for margin expansion in the solar segment. That means they are going for backward integration into solar or into ingot wafers also.
Okay. Amit, in terms of your allocation currently to gold, silver, are you at all increasing the allocation given the uncertainty? How are you playing that part of the trade?
So we have kept it constant around 10% now. So we are neither increasing it nor decreasing it. But the equity allocation, definitely we are sitting around 55% in large caps and the remaining 45% in mid and small caps.
Okay, understood. And let me talk sectors, Amit. You spoke a little bit about some sectors that you're liking, but give us the top 3 sectors on your buy list right now, and give us maybe a few lines in terms of thesis as to why you seem to be liking those.
So see, very unique sectors are coming up. For example, when I look at auto ancillary as a space, now auto ancillary, I think, can give you better returns because the market is opening up now for new FTAs. And I think finally, you will have the signatures, everything done in financial year 27 from Europe, from UK. And this is where some of the export-oriented sectors, for example, auto ancillary and textile, I think they are looking better to us in the mid and small cap space. And when I look at auto ancillary, there are companies in this space which are also in decorative aesthetics. I think that's also very essential. Not necessarily an auto ancillary has to build a component which is required in the final composer of passenger vehicle, but just to give a look and feel, just to give a more luxury feel. I think this is where more designing will come into picture, more R&D will come into picture. The margins in these type of components can go to 24 to 30%. And I think those companies are coming up in India. So, and if you do a hard work, you will find some companies like that in this kind of decorative aesthetics domain, around 5,000 crore market cap also, where there is a substantial room for growth.
Interesting. And Amit, talk to us about the sectors which are currently not being preferred, or rather have suffered some serious underperformance. The likes of private sector banks. How do you sit on those?
So our sense is mid-size, private size banks can do better going forward. See, PSU banks were also looking fine, but if the crude prices are going higher and the bond yields can surge because of that, then I think the treasury profits can see some dent in the PSU banking because they have a larger chunk in the treasuries also, because they are holding good number of GSECs. But when I look at mid-sized private bank, I think there are certain companies which are doing exceedingly well. Credit growth, it is growing much higher than the industry. If the industry is growing at 11% or 12%, there are some mid-sized private banking companies which are growing at 17% also in credit growth. They are garnering 16% of deposit growth. They have a return on assets in excess of 2%. They have a return on equity around 18, 19%. So I think if you look at the GNPA also, there are some companies which have only 0.7% of GNPA, and particularly from the southern part of India. So southern part of India, those banks are doing good, which have around 900,000 branches. I think we can particularly look at those areas, and I feel they will grow much better. See, going forward, if the bond yields are going higher and interest rate starts kicking up, if I am assuming this scenario going up, only in that case it can happen, then it may be little negative for NBFCs, but maybe positive for banks.
Okay. Okay. So yes, that's negative NBFCs, positive banks. Amit, give me a sense, this new ECL framework, how negative PSU banks, and given the fact that PSU banks have seen some serious outperformance versus private sector banks, could there be a shift or a tilt? And is this that point, according to you?
See, in fact, if you see from 2018-19 onwards, there is a significant change. There is a significant improvement which has come in PSU banks. See, they had the slippages of close to 2,86,000 crore. Now they are sitting at a slippage of hardly 65,000 crore. If you see private banking, which had a slippage that time of around 70,000 crore, they are sitting at a slippage of around 1,20,000 crore, because there have been certain instances of moving into microfinance big time. So my sense is PSU banking, which was losing market share to private banking also, there is a significant improvement in technology. And this is where, and also in terms of deposit growth, they are doing much better, because we have seen instances of some cooperative banks also going down. And so I think the pupil interest has gone back to put deposits in the PSU banks also. So they can do better. Their loan to deposit ratio is much better. I mean, much lower than the private banks, some of the large cap private banks. So only thing is, if this provisioning, I think you are talking about, that if more provisioning has to be kept, see, we are looking for long-term investment. We feel the risk to the risk adjusted return will be now much better, because you are not going to have many negative surprises. So market will give you a consistency of returns. And I think this is where it is. If the mid-size banks also can do better, because there was a more chance of getting some negative surprises. So it's a good step, which will be good for the broader banking index.
Interesting. And where do you sit on where IT is concerned? Is that at all an allocation in your current portfolio at all?
So we don't have exposure. In fact, we did not have for some time. But valuations are very attractive, no doubt about this. If you look at TCS 16 times valuation, margins are still around 24-25%, though the volume pickup is not there. And if you look at those companies which are increasing AI exposure, I think they will garner better growth going forward. When I look at some large cap IT companies like TCS in Q2, they had some exposure of around 5.5% to the AI in the overall order book, which has now grown to 7.5%. So they are improving, but still it is lower in terms of the total order book. So that is where the execution will still remain a question mark, which is a problem right now. The order book is not a problem for IT companies. The execution, the delaying of the projects is the problem with the IT companies, which is not getting reflected in the revenues. So those companies who are more into AI, their execution can be faster. So I think mid-cap IT can come back after some time. Currently, they are down. And so my sense is the growth will come back faster there.
Okay. And how do you play the AI trade, Amit? Because there's such limited optionality. I'm sure that's one question you get all the time. There has to be some way to play this, right, in the Indian marketplace. What's the most efficient, or where is it that risk reward is the best at this point within the AI trade?
See, I think there are two, three ways you can look at this. One is the equipment manufacturers for the data centers, maybe server kind of companies, ancillary companies. Maybe if you look at the genset companies, because continuous power is required in the data centers. Then I think the rare earth companies also are there, which are going to be benefited because these critical minerals are required for semiconductors also. I think that is how you need to look at this space. We don't have direct players for AI, but we do have the rare earth reserves of almost 8% in India. And China, when they put the curves actually on the rare earth export, that is where we realize this, that we have to deep dive into this more. And I think those companies have already started performing now. So that is how we can look at. I think IT companies, they are working on small modules for artificial intelligence. And the next phase for IT, from body shopping to the services, I think it is going to be some product proposition also. Because if you are creating some own built small modules for AI, that means you may garner a better price to earning going forward because you will become a more product company. I think that is a transition phase for them, but eventually I think that is how it is going to turn out.
Okay. Amit, great speaking with you. We've spoken on a wide array of things. Thanks so much for coming in and giving our viewers that perspective.
Thank you.
All right, and viewers, what we'll do is slip into a very short break and come back with more. Stay with us here on ET Now. Welcome back, viewers. And you know, the big news today, and that's keeping pressure on the Nifty PSU Bank, is the fact that the RBI has kept its ECL framework largely unchanged. ECL standing for expected credit loss. And the draft has been unchanged. There were certain changes which were proposed by the banking system, but that has not been accepted by the RBI. They finalized that draft, and despite industry pushback, suggested that that draft be implemented from 1st of April 2027. Let me go across to Ankur. He's here with a lowdown with regard to what exactly does the final, the final regulation state.
Yes, exactly. So the draft norms have been exactly kept unchanged, and Reserve Bank of India has now given the implementation date of ECL framework, which is from 1st of April 2027. However, banks do get leeway of 4 years for implementation, but as far as the norms are concerned, of course, it will be an approach from incurred loss to expected credit loss, and there are 3 stages which has been defined. Stage 1 will have a 12-month expected credit loss, and stage 2 will have the expected credit risk loss for lifetime. And similarly, if you talk about stage 3, that has been defined as lifetime losses for credit impaired assets. Overall, as far as the NPA norms are concerned, the timeline has been kept unchanged. The 90 days period still remains, but more importantly, banks were already preparing for ECL norms, and some of the banks have already made general provision for ECL framework. So that will be utilized for the banks as far as the ECL provisioning is concerned. But industry is pointing out that the impact will be more on PSU banks if you compare with private banks. In the implementation also, since the leeway is given, the hit will not be one time, but it will be spread over the years as far as the industry response is concerned. But definitely, banks will have to make more provision for ECL framework.
Okay, thank you so much for that, Ankur. Let me, in fact, go across to Puneet Balani, who's joining us from Daulat Capital. He's the BFSI lead at Daulat, to talk to us about exactly that. Hi, Puneet. Good having you. Puneet, talk to us about the larger impact here. PSU banks are obviously the banks which are going to be more impacted among the larger cohort of banks. But talk to us about how much of a hit do they take broadly?
So see, in the context, there are 2 hits one needs to monitor. One is the hit on net worth. that for all banks is around what has been disclosed, around 7 to 10%. This is based on credit rating reports, and in the past quarter when the draft norms were released, the PSU bank released their own calculations, and on calls they reported that 7 to 10% of net worth is affected. Now, yes, there is a transition period. 4 to 5 years. The capital consumption is not much every year, and plus the capital position is also comfortable. You have on an average the PSU banks tier 1 are over 13% plus, and if you include private banks for the entire industry, it's around 15% plus. So capital hit is not something it's not something to bother about. I think it's easily sustainable, whether at one go or whether in a transition base you do it. The more impact is on the incremental flow, the incremental credit cost that will be charged to the PNL, that gets impacted, and that affects your ROAs. And that the street was expecting a watered down version of this circular, the flow rate, but RBI has kept the flow rates unchanged, which means that if even as per your ECL model you are having lower provisions for stage 2, you have to carry the floor. Okay, and that is in a way more negative for PSU banks, because they don't have any contingent buffers available with them. So there is the large impact. Now, what is the impact, whether it's 15 bips, 20 bips, 25 bips? PSU banks are the best judge for that, because the data, it takes into account the data, the 10-year data or 15-year data, whatever the tenor is, the recoveries that you have had, the defaults that you have had, and accordingly, you build a model and calculate. But private banks are more insulated here because of the balance sheets being more insulated. They have created contingent buffers, whether you call it for ECL or for another any other aspect which is unnamed, but they can use that and be insulated from this.
Right.
That's where the impact is coming. Yeah.
Right. Puneet, one quick follow-up with regard to the private banking pack. Which are the ones which will be worse hit versus others? For example, I know for a fact that ICICI has a provision buffer of around 13,000 crore. HDFC has a provision buffer of roughly 25,000 crore, which can take care of some of this. Give us a sense of which are the banks which will be the worst hit.
So see, two aspects again, HDFC, ICICI and Axis, all the three have created. Axis recently created a contingent buffer, although yes, that was for the West Asia conflict, the purpose, but they also had previously they had some contingent buffers in the balance sheet. So these three, they can at least handle, or relatively better positions to are in a relatively better position to handle this. Because they have contingent buffers. Banks like Kotak also don't carry any contingent buffers, or very negligible contingent buffers. So they will be impacted. You have mid-sized banks like DCB, RBL, who haven't created much provisions. Even banks like City Union over the past 2 quarters, they created some provisions, but not enough. I don't think that's enough for the entire to absorb the entire impact. So based on now the second factor that comes in here is the loss given defaults. How much you have to carry on your balance sheet, which will be based on your past recovery efforts and the way your NPS trended, and all that will also affect. So bank wise, there is going to be a separate, impact, which is difficult to judge that which bank will be here. But on a pack, because the past LGDs were high for PSUs, you can say PSUs will have a higher impact compared to private. Within private, of course, it will differ based on the asset quality experience they've had in the past.
In terms of PSU banks, what's the one-time hit looking like, and what's the recurring ballpark? Is it 20 bips broadly that we can expect across banks?
So, see, on the recurring ballpark, BOB in the 3Q con call had highlighted around 20 bips. So if you take as a base, say SBI, and say SBI has a better exposure, like best asset quality experience than BOB, it might be 15 bips or something. So this word on the street is 15 to 25 bips, but this is, we'll get more clarity from the banks itself in 4Q. But based on what the street is thinking is that 20 bips was what BOB highlighted in 3Q. And around that, people are expecting around 15 to 25 bips. Either way, even if you take the lower case of 15 bips, that makes it difficult for the PSU banks to report 1% plus ROAs. On the net worth hit, it's 7 to 10%. But, that will be 7 to 10% was, what they had reported in 3Q for for the entire PSU pack. Private banks, of course, it's much lower. But that will be offset by the risk weight reductions that have happened. So the second circular, where RBI has reduced risk weights on certain corporate exposures, on home loan exposures, on mortgages, SME LAP loans. there they will get some capital release, and so the net impact is to be considered, which will be less than the 7 to 10% in my view. And they have 4 to 5 year buffer, to implement that. Like for 1/5 of the impact needs to be taken every year. So that way there is sufficient capital buffers available. I don't think that is going to be much of a concern. It's mainly on the incremental flow. Yeah.
Puneet, so good having you on the show, and we would have loved a much longer conversation, but Maruti's numbers and very disappointing ones in that, so got to address that. But thank you so much for your time today. Maruti, and from prima facie, what one can see is both on the top as well as the bottom line, and we should quickly mic up Shrishti and analyze these numbers. The numbers are sharply lower as opposed to what the street was penciling in. Remember, the street was actually going in with extremely high expectations from Maruti. The only watch point was what the commentary is going to be on the input cost pressures. Brokerages were broadly expecting the revenue to grow about 25 to 28% on a year-on-year basis. And on the top line figure, definitely the numbers are a miss. While they've come in at 52,449 crore rupees versus the comparable of 40,675, but the street was anticipating a much higher figure. We're yet to see what the EBITDA performance is, but EBITDA has been, largely flattish at this juncture. We were expecting the margins at around 12.3% for Maruti. And the expansion of about 12.1 to 12.4% is what the street was actually penciling in, and a PAT range of about 3,880 odd crore rupees all the way to 4,330 thereabouts. And you can see it is a sharp downtick that you are seeing on the Maruti stock, which has fallen about 2 odd % as we speak. But again, these are just the prima facie first flash numbers. We've got Naveen Kulkarni joining in on the show right now. Naveen, hi, great to be speaking with you. Your first take on Maruti as we still await more numbers?
Yeah, so the absolute EBITDA, I think, is in line with the expectations. But I think the EBITDA margins probably at around 11.7% look to be slightly lower than the expectations of around 12%. PAT numbers are definitely a miss compared to expectations, but I think the other income is much, much lower in this quarter. We need to see what has happened on the other income, exactly why that is lower. But overall, I would say that the revenue numbers look kind of in line. Absolute EBITDA looks kind of in line. Percentage margins are slightly lower. PAT, of course, is lower because of lower other income. So we need to see what exactly has happened in this quarter, and also the commentary of the management on input costs and how that's going to pan out for margins for this year.
In fact, the other income number, Naveen, as you said, it's at 500 crore versus the 1520 crore number same time last year. So just want to quickly mark that out. Hi, Naveen. This is Harsh here joining the conversation. And Naveen, but keeping other income aside, even margins seem to have compressed a bit. Talk to us about what could have caused that, in your opinion, broadly. Is it raw material prices spiking? And this is just 1 month, right? We'll have another in Q1 FY27. Likely we'll have the full 3 months having that impact.
Yeah, so again, two aspects to it. One is whether raw material impact would have had a complete impact on this quarter or not is something which remains to be seen, because typically companies tend to have inventory, so on and so forth. But more importantly, will be a factor in terms of how demand would have impacted, because of there could be high discounting, higher promotional expenses. Those are the key numbers to watch out for this quarter. Definitely the margins are slightly lower, 11.7% versus last year was 11.8%. So margins are lower, whereas expectations were that with the higher revenue growth rate, there will be some operating leverage benefit and we would see some bit of improvement in margins. That has not happened. But still the absolute EBITDA number is in line with expectations. We need to dig in more and look at management commentary post the earnings to make a better sense whether earnings will for FY27-28 will remain steady or could see a sharper downward revision.
And that really is the risk to watch out for, the commodity inflation. I mean, most companies in the auto sector have been sort of flagging it in terms of margin pressures from commodity inflation from Q3 onwards. So in Q4 now with the West Asia crisis or the conflict, the impact on input costs may be a little bit higher. And of course, the consumer sentiment going into Q1 of FY27. That's something that we're going to be looking out for. And two very important things. It's only post 5 p.m. That the earnings call is slated for Maruti. The management's FY27 volume and margin guidance, that's going to be very critical. And any commentary on the Middle East conflict's impact on the input costs and consumer sentiment, like I mentioned, is what we're going to be looking out for. But Shrishti is here. Shrishti, help us analyze how the Maruti's numbers stack up as opposed to your poll.
The numbers are below the estimate, Aisha, and especially the margin figure. The company has reported a margin of 11.7%, which we were anticipating to be above 12%. And add to that is the kind of decline that we have in the profit number as well, because there too we have seen a bit of a disappointment, because our expectation was above 4,000 rupees and close to 3,500 crores is what the company has slated. So a couple of reasons over there in terms of the other operating income, though that has increased, but in terms of the depreciation, that too has gone up, because that was something that markets were already penciling in terms of the kind of capex that the company was undergoing. But that has definitely seemed to be putting a pressure onto the bottom line. And the numbers are not that great, because for quarter four, I beg your pardon, the numbers were expected to be decent enough, given the kind of growth that we have seen in the volumes. It was a 12% growth on a YY basis. The average selling price was seen to be higher by 12%. The discounts were reduced on a quarter-on-quarter basis. But apart from these factors, even with the decent quarters, the numbers doesn't look that great. The investors are already concerned about the outlook, that if quarter four is something like this, then how quarter one will pan out, because there you have to deal with logistics issue, supply chain constraint, as well as the demand is expected to be a little soft. So that is something that we will be watching out for when it comes to the management commentary. But for now, the numbers are not looking that great. Back to you.
Okay, thank you so much for that, Srishti. Naveen, you did highlight that other income was one of the reasons why profitability was a miss. Outside of that, anything in the print that is of material concern to you at all? Because otherwise the numbers largely seem in line.
Yeah, that's what I'm saying. So as of now, there is not much to take away from the headline numbers. They look okay. Obviously, the other income has impacted the profit numbers. Margins are lower, of course, which is also a slight concern, which was expected to improve. But of course, going ahead for the stock to perform, we need to see improvement in margins, or margins holding steady, or of course, revenue growth holding on to its trajectory, right? So those will be the key factors to watch out for. Earnings upgrade will be very, very critical for the stock to perform from here.
You're seeing a 2.5% dip now on Maruti. 12,908 is where the stock is. But Naveen, just wanted to understand, where do you mark the fair value for Maruti, given that there could be input cost pressure, which the management could highlight, and of course, you know, what you've seen in terms of a margin delivery this quarter?
Yes, so input costs could be a challenge in the short term, but obviously we are in a cycle where the premiumization trends continue to remain very, very strong. The value per vehicle or the contribution per vehicle continues to rise because of premiumization trends, and of course, kind of new products which are coming through with better safety standards, so on and so forth. So that long-term trend continues to remain very, very strong. So input costs in the short term will be a challenge. Let's say Q1 could be a challenging quarter. But over, let's say, a medium term or for full year FY27-28 basis, we should see the input costs being passed on to the consumer, and obviously margin profile to hold on or slightly improve from current levels. So those are key factors to look out for. Of course, demand environment is going to be a very, very critical factor, which we need to see how that's going to pan out over the next 6 to 12 months.
Okay, Naveen, thank you so much for joining us and giving us that perspective. That's, of course, Maruti's numbers and Naveen's view. Largely seems to be a miss on other income. That seems to be the critical line item, which seems to have dented profitability. 2% knock on the stock price, though. What we'll do is slip into a very short break, come back, talk a little bit more with regard to some buzzers in trade today. Stay with us.
Back with closing trades right here on ET now. The big culprit, of course, has been Brent, because you are seeing once again a sharp spike come by in Brent prices, which are back above that $110 per mark, and which is why you can see that volatility creep into our markets as well. Of course, Maruti is the one which is still finding its feet. It's down about 2% and the numbers prima facie have been a miss. The profit and margins have seen a dip, while the revenues have seen an uptick of about 28%. But the other big story now is the RBI is likely to soon decide on Tata Sons' application to surrender its core investment company license. The move could be crucial in keeping Tata Sons privately held after missing the mandatory listing deadline for the upper layer NBFC. Anurag Joshi, my colleague, is here with exclusive details on what he's picking up from his sources.
The Reserve Bank of India could decide about Tata Sons' application on its surrender of its core investment company license as early as May. Sources have told ET Now. In 2024, Tata Sons had put an application before the RBI to voluntarily surrender the CIC certificate of registration, and a possible outcome from the Reserve Bank of India could decide whether Tata Sons remains a privately owned company or it needs to list its shares. In 2022, RBI had given upper layer NBFCs, which Tata Sons is also included, a 3-year time frame to list their shares, and according to those rules, they had a 3-year time frame to list the shares. And Tata Sons, in fact, last year on September 30, when the deadline got over, Tata Sons missed that deadline, and Tata Sons had requested earlier with the RBI to allow a waiver from the listing requirement, which the RBI had declined, and subsequently Tata Sons put an application for deregistering as a CIC. It has repaid all its borrowings to boost its case for seeking an exemption from the listing requirement. In fact, in the February board meeting of Tata Sons, chairman of Tata Trust, Noel Tata, had put a key condition for giving his assent to N. Chandrasekaran reappointment as the Tata Sons chairman, and that was that he wanted an assurance that Tata Sons remains an unlisted entity.
Okay, thank you so much for that, Anurag. Let me, in fact, bring on board Shivangi Sarda from Motilal Oswal, Ajay Bagga, market expert, also joining us this afternoon. Shivangi, let me come to you first. With regard to the move today, what does it mean? There's also some bit of pressure which is building up on the 24K level, 24,100K level, or rather 24,100 level. Those two are levels where it seems at least that open interest positions have spiked. What's your take with regard to those levels, and what levels are we open to?
Very good afternoon. Thank you for having me. So we've seen that the indices have struggled near mid 24,000 levels. There was some bit of call writers that was still present at 24,300, which have limited the upside for the expiry day POV. But overall, for the next series, we're expecting good amount of positions to carry over. Now, of course, the rollover will speak for itself, but overall, we are seeing that support-based buying is quite intact. Even at 23,980 odd levels, we'd seen that there was a good amount of buying that was seen in the last hour, in the last tick. Now, to look at the daily chart, we've seen that higher bottom structure is intact, which means that the index will kind of face some bit of support at 23,900 for the next up move towards 24,300, which is on an immediate basis. Now, of course, talking about Bank Nifty, this index has been weighing down the entire market because of its underperformance. And, till the time it doesn't cross and hold above 56,000, we would see some consolidation over here, with a support near 55,000 and the upside hurdle intact at 56,250 levels.
Right. Quite interesting. Shivani, I'm curious to know whether you track the prices or charts of crude or not, and where is it that you see Brent headed next?
Yes, Aisha. Of course, crude prices is something that we've had to track from the last 3 months very closely because of the impact that it has on the entire market. And we've seen a lot of gap up, gap downs accounting to it. Now, of course, looking at the crude prices, we are seeing some bit of uncertainty here in the broader market because of the hike in the crude prices. So this shall continue, and there is some bit of hope that we could capture in the oil marketing companies. So this is the best that we could get from the volatility in the crude oil prices. So look out for stocks like ONGC and likewise for the movement.
Let's welcome on board Ajay Bagga as well. Ajay, hi, afternoon. Guess that's what life's been, right? Last 3 months, tracking what crude does as opposed to anything else. But given the spike once again that you're seeing on Brent, Ajay, what kind of an earnings impact do you pencil in now for India Inc.?
Yeah, see, there has not been a pass-through yet, Aisha, and I am a little skeptical, though Ministry of Petroleum has come out and said that these are wrong signals that are being put in the market, that post the state elections getting over, there could be a pass-through. So the facts are in January, India bought crude at $63 a barrel. In February, we bought it at 69. In March, it went up to 114. And April again is about $114 to $116 on average. So nearly about an 80% increase in our cost of import of crude oil has happened over March and April. Who pays for that? Right now, most of it is being absorbed by the refining companies, but that's not a sustainable proposition. Overall, from a $150 billion crude and gas bill, we'll probably looking at 200 to 225 billion around these rates. So who pays for that marginal 50 to 75 billion dollars of extra import bill? Is it the Indian consumer? Is it the Indian government via its fiscal, or the refining companies? So I think that we are not very clear about. The pass-through has not happened fully, though in a lot of the petchem products, the product itself is not available. In fertilizer, the prices have gone up by about 50%, but the product is not available. So there again, the government subsidy burden will go up by about 1 lakh crore odd in getting the fertilizers in time to the farmers for this upcoming sowing season. So very difficult, Aisha, right now to put a number to the margin contraction that will happen, but it's coming. The earnings overall at a macro level for the country will go down. And if this is going to stay, now it's not an if, the higher prices will stay till about $90, at least till the end of this year for India. So you are seeing something like roughly last year we were at $70, that going to $90. That incremental cost is coming into the economy, and that will be paid for by the margins. When you pass on to the consumer, demand destruction starts immediately because inflation goes up and you see demand going down. So it's a very difficult equation which the government has to handle. Let's see what they do. We will know by May first week what is happening. But definitely the price this year stays at $90, and that $20 extra will come in on an economy-wide basis, will be paid by any of these three players.
But Ajay, likely if that fuel increase were to come through and translate at a pump level, do you believe that that will happen in a more gradual fashion, and therefore the absorption of it will also happen much better, or do you believe that it will be a one shot?
No idea, because if you see, it is about 15 rupees to 20 rupees is the shortfall per liter, petrol and diesel a little more. So I don't know how it would be passed on. I don't know how much of that is already in the price, because the government never brought down the prices, even when the petroleum, when the crude oil went down. So I'm not very clear. What we are clear is that the government collection of 5 to 6 lakh crores will not happen on the taxes. They will have to support the refining companies. They will not allow the upstream companies to make make the windfall. Normally, they will put a $70 or something to the producer. Same for gas. There will be a much lower level. And above that, they will probably put a windfall tax, or there'll be some mechanism to transfer it to the government. So that's why I'm not ever keen on the upstream companies in India, because the government will not allow them to make these kind of profits.
Interesting you say that. Ajay, as well as Shivani, both of you, hold on to that thought. Lots more to talk about with you. But let's take a look at how the earnings momentum has panned out across sectors. M&M Finance, City Union Bank, Piramal Finance and AUSFB as well. With M&M Finance stepping up provisions amid global and monsoon uncertainties while eyeing an H2 rebound, City Union Bank remaining well capitalized with limited ECL impact and MSME-led growth. And Piramal Finance is expecting a strong FY27 growth with improving ROA and ROEs as the legacy book winds down. And AUSFB, of course, sees better placed on deposits with stable microfinance and easing credit costs as well, pointing out to a stronger fiscal ahead. Let's listen in to what the managements had to say.
Provision that we made for Q4, which is a number of 270 odd crores. The rationale for creating that provision was, as we are all aware, there is a certain conflict which is in progress. The West Asia crisis has led to some disruption. I did mention in my earnings call that we are not seeing any early visible sign of stress in our collection efficiency over the last 50 days ever since this disruption happened. We saw a big departure from H2 versus H1 in F26. We were able to catch a lot of the commerce that unfolded in the passenger vehicle segment, in the commercial vehicle segment, in the tractor segment. So as a leading vehicle financer, we were very happy to see a growth in H2.
Since we have our capital adequacy ratio well above, let's say, 20%, we can afford to take that hit in the capital itself. And even after taking care of that, we should be adequately capitalized, and things should be in such a way that we will not be having any issue with the P&L on an ongoing basis. Even though the MSME, like agriculture loans, including the gold loan and all, constitute the most important part of our overall portfolio. The gold loan had in fact contributed for a significant growth in the last year, and we were able to get opportunities within our risk appetite, which we did not want to lose. So overall, we are currently at a situation where we should be able to see things in a brighter perspective as we enter financial year 27.
We expect our AUM growth to continue to be approximately 25% in this coming year. We have also guided that we expect our profits to grow by approximately 50% in this year. And thirdly, we have guided that we expect that in the fourth quarter of FY27, we will be able to deliver a return on assets of roughly 2.5% compared to the 2.1% that we delivered in this year's fourth quarter. So the legacy book, which ended this year at a little under 3% of our portfolio, will probably all but disappear during the course of this year. So what all we'll be left with is the core book.
If higher interest rates is there, it is always remain challengeable because we don't want to make our yield higher, right? So it depends, but we are much better placed than many of our competitors because we have right asset class and we have a right way to build deposits. So I think the biggest advantage we got in last 6 months is that microfinance has become more stable. Our credit cost around credit card has now coming down. That's other classes also has performed better. It might impact us a quarter, maybe 3 to 4 month period. But in the long run, I believe that this year, this financial year, 26-27, will be much better than the last year.
Okay, in the meantime, Indian Aviation is the one which is in focus right now. The Federation of Indian Airlines, Air India, Indigo and SpiceJet combined have sent an SOS pretty much to the government, stating that airlines are under extreme stress and on the verge of shutting operations, largely talking about their international operations. Remember, ATF prices have surged nearly about 75 rupees per litre on international routes, driving the fuel costs to nearly 60% of their total expenses. And that really is the urgent plea set out by the aviation industry, talking about temporarily suspending excise duty on aviation turbine fuel to try and avoid network cuts, grounding, as well as cancellations as well. So that's really the big debate this afternoon, whether the government should be looking at suspending excise duty on ATF immediately or not. Ajay, what do you sense would be the impact on the very limited listed aviation plays?
Aisha, it's a trouble across the world. I mean, in a free market like the US government is trying to take over Sprint Airlines. They're trying to put in $500 million into it. Other 3-4 airlines have got together. They've asked the US government for a bailout of $2.5 billion. So clearly, you would have seen last week Lufthansa canceling about 20,000 flights for the summer season, saying that they're no longer they don't make economic sense. The short-haul flights within Europe, they were canceling. So it is a very dismal issue. And I would say aviation needs to be looked like infrastructure, and some SOPs need to be given to infrastructure, to aviation, because the connectivity for the country is very important. And it's not a very profitable industry in the best of times. And now, definitely with these kind of prices, they are in a big fix. So I hope the government at least gives them some kind of a relief. Again, politically, it's not expedient because you would look at relief on the cooking gas front, and then on petrol front, and then diesel. Diesel, moment you hike, it comes into the food inflation because the logistics and transportation costs go up. That gets passed on very fast, and you have no monetary policy fix for a supply shock like this. So it has to be fiscal. The government has to balance out. And I would say this kind of an energy shock to such a fragile energy security-wise fragile economy like India, the government has to leave aside its fiscal prudence and step in and safeguard these industries. Look at them as infrastructure. Don't look at them as the rich person's kind of industry, but it's a key infrastructure industry. And if we lose more players, we'll have a monopoly or duopoly kind of a situation in the aviation sector.
Okay. Let's quickly also take a chart check on Interglobe Aviation before I go across to Rabinder. Kunal, how's that one looking on charts?
See, on the short-term basis, the stock has capped its gain around 4,600, 4,700 mark, which it tested in the last 3 weeks. In fact, the last 3 weeks, the stock tried to scale past about those 4,700 levels, but it was unable to surpass about those zones. And now it's seeing a mild reversal or a retracement of sorts. It's still not broken below a major support for us to try and call this as a sharp reversal for the stock price on the downside. And the major short-term support for Interglobe Aviation is at 4,300, 4,330 mark on the spot levels. We are still 2.5 percentage points higher than those key support levels for the stock in the short term. So we'll wait for this level to be broken. In case if it happens for Interglobe Aviation, I think that's where we probably look at the stock seeing some incremental selling pressure.
70% uptick on the consolidated sequential numbers for Eternal, but I'm just going to, hang in there before analyzing those numbers. The top line, of course, has seen a growth of about almost 6%. It's really about whether or not Blinkit can stay profitable, and then, of course, what the food delivery business has done for Eternal. That's going to be largely what the street is going to be eyeing out for in terms of what Eternal's performance is. Just awaiting the other numbers. Well, the profit has come in at 174 crore rupees, and that's a comparable of 102 that they clocked in the same quarter last year. So that, of course, is one such case in point. But just looking at the profitability, largely the street is anticipating is going to be driven by the food delivery growth and Blinkit's quick commerce momentum, of course. The street was anticipating the consolidated revenue seen rising about 7.5% on a sequential basis. A number of 17,530 thereabouts is what the street was penciling in. The EBITDA margins have come in at 2.8% versus a comparable of 2.3%. The bigger watch, of course, is going to be Blinkit's growth trajectory. It's the management's first formal FY27 guidance under the new CEO, Albinder Dhinsa, that the street is going to be extremely intrigued about. But we've got, I think, Gaurang Shah joining in on the show very quickly to analyze those numbers. Gaurang, hi, afternoon. Good to be speaking with you. EBITDA at 486 crore rupees, Gaurang, for Eternal. Margin at 2.8% versus a comparable of 2.3%. And I think the bigger jump has come in on the profit because of a relatively lower base at 174 crores.
Hi, thank you so much for having me on the show. It's been quite some time. I spoke to you as well. Thank you so much for having me on the show. Good afternoon to all your viewers and to you as well. So first, the standard disclaimer: with all SEBI regulations put in place, that we have a positive coverage on Eternal from a long-term point of view on the fundamental side. And I think more interesting would be to get a input from the management in terms of the number of new dark stores that they have opened for Blinkit platform. Last year, they did say that they were planning quite a few stores, newer geographies, as well as a larger customer base. So my sense is that, of course, this is a forward-looking statement by me, but I am assuming that these new stores and new markets would have possibly helped the delivery numbers.
I'll just quickly try and distill those numbers for you viewers in terms of segments. Food delivery has come in at 2737 crore. It was expected to come in at 2605. That's very likely the number which is leading the beat with regard to margins, because the profitable part of the business. When you're looking at Hyperpure, that one's numbers have come in softer, maybe 3 to 4% softer than what was penciled in. 978 crore is where is the contribution to top line from the Hyperpure business, which is the B2B arm. And that's actually a degrowth, both sequentially as well as YOY. Quick commerce has come in at 13,232 crore. It was expected to come in at 14,144 crore. So in fact, Blinkit's numbers have come in slightly softer in relative terms compared to what was expected. And the going out business was expected to do 294 crore in terms of top line versus 300 crore same time last quarter. And it's come in at 277 crores. So you've seen a slightly softer number on that count. Very likely, it's the Indian food ordering and delivery business which has led this beat with regard to margins. Margins expected at 2.5%. It's coming at 2.8%. Gaurang, how would you look at especially the quick commerce side of things, Blinkit? Those numbers softer, would you be disappointed?
Not actually, but yeah, I mean, the expectation was that Blinkit would do a little bit better. Good afternoon to you as well. But the number that you just gave out in terms of food delivery platform, definitely it has come much better, and I would be interested to know what is the market share as well compared with Swiggy to what Zomato internal has in terms of both food delivery as well as a Blinkit platform. I won't say disappointment in terms of a Blinkit platform, the kind of contribution has come in. But I would, like I said, it would be exciting to listen into the commentary from the management in terms of what they have lined up going into the future.
I was just waiting to see whether there's any management commentary as well, which has come by in the release, just awaiting that. And we'll have Snehi perhaps, who would have a better handle. Yes, the food delivery for Zomato, the NOV growth has come in at 18.8%, and that's a degrowth on a sequential basis of about 0.9%, inching closer to the longer-term expectation of 20 plus on a year-on-year basis. That's the word coming in from Akshan Goyal, the CFO at Eternal. He's talked about QCOM and what the health is. He's saying 216 net new stores were added in the quarter, taking the total store count and we will just get that total number for you. 2,243 stores is what the total count is now at the end of this particular quarter. That's the word coming in from the CFO of Eternal.
In
but
fact,
Gaurang, great to have you on the show, analyze those numbers. Yes, Harsh, any more details?
Yes, sorry for interrupting there. But quick commerce, essentially, the segmental results seem to be indicating that quick commerce has done a profit of 265 crore versus 202 crore same time last quarter. In fact, for the full year FY26, quick commerce profitability stood at 430 crore. So it's essentially the quick commerce profitability which is leading the beat, very, very likely. But Snehi here with the breakdown. Snehi, how is it that you're reading the numbers?
Good set of numbers coming in from Eternal, at least prima facie, whatever I've been able to see till now on a consolidated sequential basis. The revenue has come in at 17,292 crore rupees. It's up 6% on a year-on-year basis and in line with our estimates. What's looking even better is the EBITDA margin and PAT numbers, because all of these three metrics are a beat versus our estimates. The EBITDA has gone up by 32% on a sequential basis. EBITDA margins have come in at 2.8%. We were expecting 2.5%, so beat versus our estimates once again. And the net profit has come in at 174 crores, which is a very healthy uptick of 70.5% on a sequential basis. Overall, looking like a good set of numbers. If you take a look at the Blinkit number, and it's actually the quick commerce segment that has done all the heavy lifting this time, because Blinkit continues to stay profitable at the adjusted EBITDA as percentage of NOV level. That's a metric that they use to gauge the profitability, and it has come in at positive 0.3. 2 quarters ago, it was negative 1.3. Then last quarter came at 0, and now it's at 0.3%, which means profitability looks like it is here to stay for Blinkit. So looking good on that front as well. For the quick commerce revenue, it's come in at 13,232 crore rupees. Food delivery has also seen an uptick. It's been a very slight uptick, but this is something that we had largely expected. So no complaints on that front as well. Hyperpure business is under pressure as expected, very nominally, and same is the case for their going out, which is their district business. So largely in line with our estimates in terms of the segments, but all round looking like a beat. And on Blinkit's growth potential, the management says that quick commerce today is still concentrated at the top 15 to 20 cities. There is headroom for growth, and they're more confident now of reaching that 4 to 5% of margin for Blinkit. They're more confident now than ever. That's the commentary. So to sum it up, good set of numbers from Eternal.
It is, and QCOM, that surprised so positively. You can see that play out on the stock as well, while it dipped into the red, and now you're seeing a very, very sharp spike up, 1.25% higher for Eternal as we speak right now. And, it's quite surprising at a time when you've got the third QCOM player, which is waiting in the offing for a potential listing, which should happen soon. But you've got Eternal, which is, the Blinkit faction, which has delivered the way it has, 259 now on the stock price. It's already nudging that 260 per share mark. Ajay, would you want to comment on the QCOM space specifically within the listed pool?
Yeah, overall, they are well funded, Aisha, but still, I think we are looking for growth as well as some more profitability. I think that's what the market will look at. Guidance will be very critical. And the next phase, as oil prices flow through, what happens on demand, I think that's very critical. Again, the consumer economy in India still doing well. Urban demand growing at 8%, rural demand at 5.3, 5.5%. So right now we are okay. But what happens when the oil pass-through happens? That's the big question. It will impact all these consumer-focused companies as well. That needs to be seen. So we'll wait for the earnings call and see what the management guides for.
So wait for the earnings call, but 213 stores added, 216, I beg your pardon, net new stores added in the quick commerce side of things. They've done an EBITDA of 37 crore in QCOM versus the 4 crore in the previous quarter. So you've seen a sharp spike. With regard to food delivery as well, you've seen a decent growth, but QOQ, you've seen food delivery take a bit of a knock. When you're looking at the commentary which is coming through, it seems that in terms of growth, the NOV growth, at least over the last 3 years for Blinkit, has been 104%. Albinder says, as part of the commentary, that in the next 3 years, the NOV CAGR, which is the net order value CAGR, should still continue to be north of 60%. And that will mean that the business is another 4x or 4x plus from here in the next 3 years. So some very strong commentary which has come through. While I'm going through it, of course, there's more to be looked at. But broadly, that's what's coming out of Blinkit. And Blinkit obviously now sitting in the green as a result of that, Aisha.
Yeah, absolutely. Just marking down what the dying minutes of trade are actually entailing. While it's been a choppy ride for us, and I think the biggest sore point has been the fact that crude or Brent prices have once again spiked 216. But before that, let me thank Ajay Bagga, Kunal Bothra and Shivangi Sarda for their time today. 131 points lower is how we're shutting shop, again testing the 24K mark for the Nifty futures. The big eyesores today, technology once again, Interglobe Aviation, Maruti, disappointing set of numbers there. 2.25% lower is how that stock is shutting shop. Down 2% for SBI, Ultratech Cement, ICICI Bank, Eicher Motors, Bajaj Auto, Unilever. They've been your big disappointments today. But on the flip side, there was strength in Reliance, there was strength in Bharti today. ONGC held out 5.5%, and I don't think had it not been for these key heavyweights, it would have been a much sharper fall for the index alone. Even the breadth of the market got skewed towards the declines a tad bit. SBI Card, Tata Technology, Union Bank, Laurus Labs and Piramal Pharma were your laggards this afternoon.
And when you're looking at how Eternal is shutting shop, that one came out with numbers. The other one was Maruti Suzuki, which came out with numbers. Let's pull out both of those. Outside of that, a Castrol, a soft kind of day, posts the numbers. Info Beamstech, after those numbers, up 7.5%. SBI Cards down another 3.5%. Numbers came out yesterday. We saw the stock reaction yesterday. Now we had commentary plus brokerages and 3.5% lower on that one as a result. Leela Palace Hotels was the other one which came out with numbers, 1.5% knock on that stock as well, as is what we can see at close. In terms of the Nifty Bank, pressure there, 1.5% lower after RBI finalized the ECL regulations, put out the final notification effective 1st April 2027. You saw the Nifty Bank sulk, 1.5%. The Nifty IT was also down 0.5% thereabouts. So pressure on the Nifty was evident. But the mid-cap and small-cap indices have been surprisingly resilient. They've both closed in the green. They continue to outperform. Motherson Wiring is the one big laggard in trade within the Nifty 500 basket, 4+% lower. Tata Tech nearly 4% lower. OneSource, Canfin, Thermax, India Cements, Elecon all down over 3.5% in trade today. 13% higher on Cohance. That stock is now on a tear, 35% up nearly over the last couple of days alone. It's been a very, very strong move on Cohance Life. Tata Chem is the other one, 11% higher. Piramal Finance on the back of the numbers that it posted, up 9.5%. Chennai Petro has reversed the losses of yesterday, 7% higher. RK Forgings, RR Cabel, Intellect Design are just some of the other big movers in trade this Tuesday. But broadly, that's all that we have for you. From Aisha, myself, and everyone who puts this show together, thanks so much for watching. Stay with us here on ET Now. More action to follow.